All right, so welcome everyone. This is my 2021 payroll update. If you were with me on the PPP session that we just ended, that was a very short session with not an opportunity for Q&A. That was something we put in just to get a lot of PPP information out there. This one I do have time for Q&A. I'll keep an eye on the chat. And if I do miss something, we'll kind of come back at the end and cover it. There is a lot of information that I will be covering, and if you are not already aware, we will have these slides up on our website, as well as a video recording, so you'll be able to go back and watch this. So the first thing I want to do is apologize if I had anything to do with this, but this was my opening slide for last year, 2020, and I kind of gave the presentation that it was not going to be a happy new year, it was just going to be a new year, and I eerily have this image that looks like a coronavirus, so I really don't think I predicted anything. It's coincidence, but to kind of eliminate any sort of voodoo issue for next year, here's my new slide for 2021. It is going to be a happy new year. It's going to be a great year, and so I hope we are all prosperous. But we got to wrap up 2020, and of course the one topic is COVID-19. I'm going to go through a few topics here, and I've got them organized in the categories. So on the COVID front, the first issue is the Social Security deferral that employers are allowed to take. Back in the CARES Act, this is something that passed, that as an employer, you can choose not to deposit your Social Security tax until 2021 and 2022. So it's a fairly long time. It gives businesses some extra capital to use, and hopefully help with the cash flow. What's an unknown right now is how that will be paid back. So the balance that you've accumulated through the end of this year, we don't know if the IRS is going to send a bill. We don't know if you're just expected to remember. We'll cross that bridge when we get there. And we do have a number of companies taking advantage of this. So this was a good benefit. A bad benefit, this came out of an executive order. Felt it was kind of rushed. Some people say it was just a political move. But the employer was allowed to defer. So this came out that says, well, let the employees defer. And we do not have a single company taking advantage of this because it's just not a great deal for the employees. In essence, they were able to not have any Social Security tax taken out for 4 months, from September to December, and then starting next year, they would in essence pay double the tax January through April. So it is not a great deal for an employee. It would seriously affect their cash flow. Plus, on the employer side, if that person leaves, let's say December 31st, it's now a collection problem for the employer. So you now have to collect that money in order to pay. And you have to pay it anyways, because if you, the employer, don't pay it, you're going to be penalized and not the employee. So again, we didn't see anyone take advantage of this. What a lot of employees are taking advantage of, which is actually mandated, anyone not offering this can be in violation of a minimum wage. So, please offer this to your employees. This is the first act that came out that allows for federal paid leave for your employees for 6 different reasons. And it's actually 5 reasons, and I have them on the next slide. In essence, the employee is eligible for 2 weeks of leave if they are directly affected or indirectly affected by COVID. And If the employee is out for emergency FMLA, which is specifically the reason caring for a school-aged child, they get another 10 weeks. It's federally paid through a tax credit, and that tax credit is taken on your next 941 deposit. So if we are the payroll service and you paid $2,000 in this family's first leave, then when we send the taxes to the IRS, we short the taxes we transfer from you to the IRS by $2,000. So you get an immediate credit. When this came out, this was set to expire December 31st. I'm in the belief that with our expanding numbers of infection rate and hospitalization, I believe once the administration, whatever administration gets set in the White House, that this will most likely get extended. But for right now, we are basing it on this runs out December 31st. These are the 6 reasons. As I said, number 6 was a catch-all. They threw this in there in case something else came about that they can say, oh, well, that's number 6. So it's really just 5. The first 3 are employee-related. 4 and 5 is the employees indirectly related. So they're caring for a family member or caring for a child. So I've done a whole hour presentation on FFCRA, so there was a lot of details. Again, you can go to my blog.paymaster.com, and I have all the details there. We get into wages now. And I had this slide up last year. This bill was passed by the House in, I think it was September 2019, to increase the federal minimum wage to $15 an hour. It died after the House. It's still alive, I suppose, but it is something that's out there. It's possible. But regardless of the federal, we already have 8 states who have voted in and on their way to $15 an hour. Florida is the latest one, and if you are in Florida, and if you voted this past election, it was on the ballot. It passed by 60% for, 40% against. And 2021 is going to be an interesting year because in Florida, we already indexed our rate of pay by inflation. So it was announced in October, our rate will go to $8.65 an hour on January 1st. Then this will kick in, and our rate will increase from $8.65 to then $10 an hour on September 30th. And September 30th is our new marker. So every year thereafter on September 30th, our rate will go up by $1 per year until we hit $15 in 2025. It is still on the books that Florida's minimum wage will then adjust by inflation. So 15 is not our end point. So 2026, we will go up by inflation and be above $15 an hour. It's still a little early. There's still states coming up with minimum wage. I believe we've tracked 20 of them so far. If you receive our monthly newsletter, or again on our blog, I will have an article posted sometime probably late December with a full list of rate changes. And as I state here, it goes beyond the state level. There are localities that have adopted minimum wage. So California, New York, Washington. Washington has localities and cities, I think, well above $15.50 an hour already. This is also a slide I had up last year, but I just wanted to reiterate it's important. If you have a salaried employee in the old days, 2019 prior, for a very long time, a salaried employee could be paid as little as $455 a week. That changed on January 1st of this year up to $684. So hopefully you don't have any salaried employees making less than $684. And just like minimum wage, we have found that I list there at the bottom, there are some states that have adopted a higher minimum wage for salaried employees than $684. So I believe California, Maine, New York are a few of them. So. Right. Forms. So one of the reasons why I said this would be kind of a chaotic year last year was the W-4 form. And, you know, boy, as my definition of what would be chaotic in 2020 has changed. We seem to have kind of ignored the whole W-4 form. There is a new 2021 form in draft out there. It's the same as this year, so no big change. But the big change, and if this is one thing you take away from my presentation, it's every employee needs to be on the 2020 form or 2021 form. That'll come out in December at some point. Before the first check of 2021. Reason being is this was our transition year. This year, the IRS allowed us 2 tax tables. They allowed what they called the 2019 tax table, which allowed us to calculate based on allowances, so single 2 allowances, married 4, or whatever the combination may be, or the new 2020 form, which is rather complex in its calculation. But after this transition year, there's only going to be 1 tax table, the one based on the new form. Therefore, if there's an employee in a payroll system with single and 2, that is going to be seen as no form on file, and they will be in at the highest withholding rate. So, you know, get these forms. It's already mid-November, so there's not a lot of time. For employees that have questions about how to fill out the W-4, because it is more complicated than the previous ones, the IRS has been promoting this paycheck checkup website. The employee can go there. It's an interactive Q&A, and at the end, the IRS will tell them how to properly fill out their form to kind of keep them within a few $100s of their tax liability. We have I say a new, but it's actually a resurrection. The 1099 NEC, which is an acronym for non-employee compensation. So previous years, if you had non-employees, you know, contractors that you paid wages to, or I guess you wouldn't call it wages, you paid money to, you would issue them the 1099 miscellaneous. The 1099 miscellaneous is breaking apart. This takes place of the non-employee compensation. And if you're interested in any trivia, this form was last used in 1982. That's when they consolidated everything to the miscellaneous form, and now 30, 40 years later, they're going backwards.
Ramya, if you don't mind, we have 2 questions here for you. One is, can we push them in Paymaster for our employees to redo them?
So yes, if you are included with our base payroll, we can give you the ability to have the employee fill this out electronically right in our system, so they don't have to use a paper form. We've had a number of companies where, as if you sat in on Joshua's session, he talked about, you know, electronic forms and notifications. So when the employee logs into the system, a message can pop up on their screen that says, please fill in a new W-4 form, and we can provide them with instructions or a link to the IRS on that paycheck checkup. So yes, we can notify the employees.
Okay, and one follow-up. There's another question. How do I know what year form I may have on file? Many of my employees were hired way before myself, so I will need to have everyone fill out the new form before the first of the year? Question mark?
Yeah. All right. So in our system, if you are using our payroll system, in that tax section, there is it's a field. It says actually 2020 form, yes or no. So, and then there's reports. You can get with your payroll specialist. There's a report that you can run to see everyone who's a no, so you know exactly who needs to fill out a new form if you want to follow up with them. I saw a question about the 1099 as I look. So the miscellaneous form still exists. It's still for other things, but it is no longer for non-employee compensation. That has been broken out. So again, that's the non-employee compensation is my only concern that we keep track of, but there are many other 1099 forms. There's like a rent and royalties and interest and so forth. So 2021 W-4 has not been finalized. I have seen the draft. What the IRS is waiting for is the completion of the 2021 tax tables. So once they have that, then they will publish the final copy. So we expect that to be sometime in December. Yeah, and as far as who fills out the W-4, anyone that's hired since January of 2020 should be on the new form. So what you're trying to do is get everyone who has not filled out the new form. So if you have an employee that's been with you for 15 years and the W-2 they filled out was 2005, great. It's served its purpose until this year. They now have to fill out the 2020 W-4 or 2021 if that's out. Either one of those will do. Also on forms, it's really not a new form. It's a change on the W-2. The PATH Act of 2015 also included for the provision to, they call it truncate. I say it's a bad term for truncate. It is more of a masking, but to allow the Social Security number to be masked on the W-2 form. This has been out. They have taken, I guess, inquiries from organizations and people, and there was not a lot of feedback, so the IRS passed it to start this year, 2020. So the forms we would produce in January, we can mask or truncate. We've made the decision, as well as a number of other payroll services, not to offer this, even though it's allowed. It's optional. And the reason being is we don't feel there's enough press. We feel that states are not prepared. As I read through all the responses, and only one state responded to the IRS. And they said, yeah, that's fine. But I think when employees file their W-2s to their state or present it to their tax preparer, I think being a pioneer in this case is going to be bad. So we are kind of forcing to say, all right, we're not giving this option to anyone for 2020. We'll reevaluate for next year, but this is allowed. Also on the topic of SSNs, I had a discussion in my presentation last year that it has always been in the IRS's power to penalize $50 if a name and W-2 does not match when the W-2s are filed. I mean, as they've always had it, but we've never really seen it enforced on a small scale. So if you had 100 employees and 5 didn't match, maybe even 10 didn't match, you'd never hear anything about it. You know, if you had like 50% not matching, which is, you know, that those numbers are just crazy, then, you know, maybe that will stir SSA and the IRS. But last year, SSA announced that they would send out what they called an educational correspondence, that if you had one form that did not match, you can have 500 employees. If one does not match, you were going to get a educational letter from the from SSA, and it's going to say, you need to fix this. And I think they even asked for a reason. And we saw a lot of companies get those letters, you know, have to respond. You know, unfortunately, as your payroll service, we do not get copied on those letters as we do like IRS notices that we can respond to. Just a few months ago, the IRS came out with this statement of reasonable cause. My feeling from being in the industry is that the IRS and SSA are on a path of zero tolerance. So they've now said, all right, reasonable cause. Why is it wrong? And if it was wrong because, you know, the employee got married, they changed their name with SSA, they never notified you, this has been an employee for 10 years, and you have a good history, then based on this reasonable cause, they're going, okay, you're in the clear. I have a feeling this is the next step in a zero tolerance where they're going to start. So when you hire someone, make sure you verify. You know, you can use e-verify. You can do an SSN verification with SSA, and we also have a service where we can verify all of your employees before year end. All right, this is another act that came out previously, and it has some milestones that are into the future, so I will probably bring this one up in years to come. When it comes to the W-2s and 1099s, we file everything electronically. You can have one W-2 and we file electronically. The IRS states you're not required unless you had more than 250 W-2s in the previous year. What this act does is it's lowering the threshold and it's combining statements. So the catch here is if you have 300 W-2s and 2 1099s, you know, we're filing your W-2s electronically, but if you're still doing those 1099s on paper, then those may need to go electronically. And that threshold is going to drop from 250 to 100 and eventually to 10. They are on that same path as Joshua preaches, paperless. And they're going to be down to 10, so they are essentially saying, hey, we don't want stacks of paper, we want to be paperless. All right, taxes. This first slide is taxes, but it is kind of COVID related, and I don't have all the information in here of every state because, again, this is a huge topic, and I've seen a lot of articles come out about this by different news organizations about employees getting a tax surprise when it comes tax time next year. And the issue is state income tax. And I can best explain this with an example. We have a company they hired an employee pre-pandemic, let's say Ohio, and that employee was to move to Florida. Company's based here, all the employees are here. But because of the pandemic, that employee is going to work out of Ohio. The company has no business presence there, but they are able to work from home. So let them stay there and and move whenever the coast is clear. Well, pre-pandemic, that employee would now become responsible for Ohio taxes. You have someone living and working in another state, you need to collect and pay income tax and unemployment tax to that other state. Because of the pandemic, a number of states have stepped up and said, all right, we're declaring an emergency, and we understand that people are working from home that wouldn't normally work from home, and it's at the convenience of not spreading COVID. So as I point out here in Ohio, for example, they are letting that employee work from home and kind of turning looking the other way and saying, all right, yeah, they're working here, but we know that person really should be working in Florida. We're not going to tax them. There are some states that do not take that stand, who did not make an emergency declaration. I don't know those states offhand. I think that may be on our website, but if anyone has that question, you can throw it in the chat and we'll get you the list. But it's just something to keep in mind if you do have employees teleworking. And I guess it goes the other way too. So if you're based in Florida and you go, okay, like for us, 99% of us are working from home. If I have an employee that says, you know what, I find it's safer for me to go to Ohio and stay with my parents, and we're gonna hunker down there, then I don't have to worry about Ohio taxes. I can just keep treating that person as a Florida. All right. Unemployment. If you sat in on the unemployment conversation earlier, I'm going to talk about some other things on the unemployment front, more on the tax side. And the first up is the taxable wage base. If you were not already aware, as an employer, you pay taxes to unemployment up to a certain amount of wages. It's not on this list because we didn't change. In Florida, it's only $7,000. If you had an employee in Washington, then you are now paying the unemployment tax up to $56,500. So there's some significant amounts out there. I believe those are the only 4 states I've seen with a change for this year. And it's not uncommon for states to increase that, so I don't believe this may necessarily be COVID related. So here is a piece that wasn't touched on in that unemployment section. And there's a lot of big numbers on the screen here on the right. So as an employer, you pay 2 unemployment taxes. You pay a federal and a state. The state tax you pay goes to the state fund. They have the money for when there's claims. The federal money goes to the federal government, and they literally just stockpile it. You don't collect unemployment from the federal. They just amass a lot of money. And what happens is, if a state needs money, if they run out of their pool, then they can go to the Fed and say, hey, we're out. We need to borrow some of that money you're holding. And the Fed will loan it to them. It is a loan. So no interest loan, but nonetheless, it is a loan. The chart on the right, I pulled those numbers 2 weeks ago on October 28th. And if you are in California, for example, the state of California has borrowed $15 billion from the federal government. In total, it looks like there's close to 40 million. And I would say over the last 2 weeks, there's probably even more borrowed from the Fed. So over $40 billion has been borrowed from the Fed. fine. The repayment of that is 2 years. The state has 2 January 1sts, and then they have to pay it all back, every penny, by November 10th of that second January 1st year. That is most likely not going to happen. So what happens then? The math behind it, and maybe I'm going to get technical here, is your federal unemployment is really 6%. The federal government gives you a 90% discount. You have no choice. You're kind of a captive consumer, but they give you a 90% discount, and they only charge you 0.6%. But that gives them the opportunity to kind of take back some of their discount, and that's what happens here. And the best way for me to show you an example of this is to go back into our recent history. I put together this table. Our last financial disaster was 2008. At the beginning of that year, we had a low 5% unemployment in January of 2008. Where do we go? By December of 2008, we jumped to 7.3%. We hit a maximum of 10% unemployment in October 2009. So again, for 2008, 2009, states were taking money out of the Fed. So we see here we had a January 1st of 2009, January 1st of 2010. And starting in 2011, let's pick on California again. So by November 10, 2011, California did not pay back the money it borrowed in 2008. So this is an additional tax all businesses in that state pays. So it's kind of like the IRS saying, all right, if the state doesn't pay us back, we're going to charge you interest. It took California until 2017, actually probably 2018, to pay back that money. So in calendar year 2017, any business in California was paying for the unemployment claims in 2008, an additional 2.1% of federal unemployment tax. Kind of what does that mean to us today? Well, our unemployment was at 14.7% in April, kind of dropped down to where we just under 7% ending October. So we're going to see the effects of this in 2022. And this tax does come as a surprise, and I'm sorry to deliver bad news at the time it comes out, but the state has until November 10th to pay back, and if it doesn't, the IRS applies this additional tax retroactively for that year back to January 1st. So in December, you get this surprise tax bill that, hey, master, if you're with us, we're going to calculate and say there was a credit reduction. So I guess the good news, if you are in Florida, Florida is not on this list. We have a pretty good amount of money in the Florida pool. In Florida, we started this year, or in March, we had about $4 billion, and we're now at a low point of just about $1 billion. So Florida still has an amount of funds that will be used, and hopefully we don't get into a credit reduction here in Florida. And here's my other category. So kind of some miscellaneous things that tax law changes. Mandatory sick leave. So we know we have the family's first sick leave for COVID-related sickness, but many states have put into play a state mandated sick leave. I've just listed the 3 new ones here. So Nevada started actually earlier this year. The condition is you need 50 or more employees in your business. Maine, if you have employees in Maine, this starts January 1st, and it's for businesses with 10 or more. These sick leaves are for companies that don't already provide a paid time off. So if you already have paid time off or sick leave, then that's better than what the state mandates, then you're fine. You don't have to offer this in addition to. It's really only for businesses that don't offer anything. California has a paid family leave, and the change that took place this year is effective July 1st. The paid family leave went from 6 weeks to 8 weeks, so a little bit of a change there. But I think the bigger change in California is that they added another type called military assist. So now if you have a spouse or partner, parent, child who's in active duty and going out on deployment, you are now eligible for paid family leave. So California seems to be a state with a lot of technicalities. This slide is also one that hasn't changed since last year, and I don't foresee anything changing. And just something that's good to know. Sometimes it comes as a surprise. But all of these states have what's called a 0 to 1 day termination pay. So when you part ways with an employee, you may have to pay them before your next scheduled payday. And many differentiate, I should say, whether it's voluntary or involuntary. So, for example, in California, if you terminate someone, you have to pay them on the spot that same day. If it is a voluntary where the employee comes in and says, hey, I'm resigning today, or actually they have to give notice in California, that it's 72 hours. If they don't give you notice, then it can be on the next payday. So each of these states, again, there's a lot of information out there, and we put out a lot of information, which is my next slide here. There's a link from our website, but you can get there through blog.paymaster.com, and I've been writing articles every month, or it's a lot of cases twice a month, so sometimes about 15 a year, and I've been doing that for over the past 5 years. It's kind of a depository of information, and some of it doesn't go out of date. There is a search bar, so if you look on the right side of the screen when you're on that website, there's a search bar. You can type in whatever you're looking for. And I do try to write these in fairly easy to understand language and lay things out pretty clearly. So you have this as a great resource for you. And I saw a couple of questions. So yeah, from the mandated sick leave, it is Pittsburgh. So again, sometimes states come out with their own laws, and sometimes cities and localities come out with their own. So just like minimum wage and salary, it is Pittsburgh that comes out in March 15th. The employee must get 5 days a year. If they were a large employer, 3 days for small. I apologize, I didn't notate what that employee count is. But if you do have employees in Pittsburgh, then take a look for that. But that is the kind of the conclusion of my my 2021 update. So it is not actually too bad. The biggest thing that will be an inconvenience in the next couple of months, other than COVID-19, is that getting that W-4 form and having that updated. Otherwise, employees will have a little bit of a shock when they look at their paycheck and see a lot more federal taxes coming out. So. All right. I don't know if there are any questions. I am keeping an eye on the chat here now. I know I went over a lot of information, so as I said, there's going to be these all of our presentations posted online, as well as a video recording. So if you care to relive it.
Also, everybody, we did post the credit words below. If you came to the session for educational credits, we do have those credit words posted. So hopefully you've been looking at the messaging tab.
Well, I know I gave myself about 15 minutes for Q&A. If I've done a good job, then I guess there are no questions.
It was too much information that they can't compute.
It is a lot of information. When I got to my computer this morning, I found a note on it from my daughter. She knew I was presenting this morning, and she left me this note. Said, "Don't suck."
How many people can make taxes entertaining? I mean, only very few. Romeo, you're one of them. So let me do this. Let me check the crowd to see how many people are still awake. Just type in awake in the bar.
I see.
There we go. There we go. We got people. We still got live bodies. You didn't put them to sleep. I like this. Like everybody's awake, Romeo. I think we're good. Only half of the people are asleep right now. That's it.
All right. So there's a question: if employees do not complete a W-4, get our employees out to a minute. I think we are. Yeah. So if the employee does not fill out the new form, again, a payroll engine is going to look at that and say, what is this number of allowances? I don't know what to do with that, and the payroll system is going to default to the highest tax rate, in essence, single. And it's really not even single anymore. It's now a different. It's like single or married filing separately. So there's not even an equivalent of single or married. The options on the new W-4 are just completely different. So I had someone ask me outside of this conversation, can we just, look at what they had and kind of make an assumption and change? So, all right, you're married and 4. Well, we're going to make you married, and well, if you're 4, what are you doing? Are you estimating that there's a husband and wife and 2 children? So I think there would be too much guesswork in doing that. And what the risk is, if you go in and you update an employee, what I would foresee happening is, the end of 2021 comes, they prepare their 1040 for 2021, and they come up short. They're underpaid by $500, underpaid by $1,000 because you estimated something that wasn't true. The employee didn't catch it. That is going to be an upset employee because then they will be penalized by the IRS on their 1040, and they're going to come back to you and say, wait a minute, that was my employer. I didn't fill out a new form. So, so the safe way, have the employee fill out the new form. And I said it last year, don't offer advice to your employees. I understand you may want to help them, but I can see that turning into something as well where, again, they turn out short. And then they come back to you and say, well, you filled out, or you told me to put this, and they turn up short. So it's important, if they can't do it, direct them to the IRS. That way it's only the IRS that they can blame. And I blame the IRS for plenty. So they brought me in 2020 W4. List his income on my W. All right, so kind of the chaos of last year about the W4 form is that it asks personal questions on that form, and you as an employee are going to be giving your employer a form that says how much your spouse makes at work and how much you make in other income, and your itemized deductions, and an employee may not want to disclose that information. So the IRS calculator, that paycheck checkup, has a way of filling out that form to kind of mask that information so it's not being disclosed. So if you have an employee with that concern, the paycheck checkup is going to tell them how to fill it out in a concealed manner. The W-4, from what I see, only comes in English and Spanish. Usually English comes out pretty quick in December. The Spanish version sometimes takes until January. I've seen it as late as February, and I've seen it earlier too, but I haven't seen other languages. And yeah, directing the employee. An accountant may charge for assisting someone or their tax preparer. That paycheck checkup is going to do just as good, if not better,